all my dear MOS members, the ophthalmic fraternity, and those who have joined, dear audience on the YouTube, Facebook, and the web portal. Maharashtra Ophthalmological Society is conducting a financial literacy series for their own members. And we have today experts on for us to speak and guide on a topic which is a must for those people who are dealing with share markets. To get an insight into the technical analysis is very important. If you really want to invest and grow, if you are good in technicals, chances are that you have upper hand in the stock market. And here we have experts to guide us on it. We have Grishma Shah. She looks young, but she is so matured and so good in her technical analysis that you will see that at the end of the day, you are rich with a lot of technical analysis. And with us, we also have our in-house consultant, Dr. Trupti Kadam. She is, we have started a group by the name of the Investment Groups for Ophthalmologists. Well, she is part of that group. She keeps giving us a lot of ideas about the technical analysis, how to go about it. And so I thought that she is the right person today to moderate the whole session and also speak on certain aspects of technical analysis. Two subjects we have chosen, which are the basics of technical analysis to start with, and we'll to go up the ladder as we learn once the basics. We also have with us a giant expert in technical analysis, Mr. Vivek Bhatia. More about his introduction by Dr. Trupti later on. And as I just said, Grishma Shah, she's been doing it for a long, long time. She is guiding us on various Telegram and the WhatsApp groups. And it is what we say tribute to both of them to have guided us, all the doctors who are not very good at the technical analysis. So I welcome you all, the dear audience and the whole panelist group. We also have Dr. Rajesh Joshi, our honorary secretary, who is the backbone of Maharashtra Ophthalmological Society in the panel group. So now I hand over the session to Dr. Trupti Kadam. She is going to introduce our guest speaker, Dr. Grishma. Mrs. Grishma, I should say doctor because she's very good in technical analysis. A PhD sort of in technical analysis, an unofficial PhD. So over to you, Trupti, for the further proceedings and introduction. Happy learning to all of you.
Yes. Good evening, everyone. Good evening, everyone on the board. I thank the Maharashtra Ophthalmic Society at the outset, Dr. Taswala sir, Dr. Rajesh Joshi sir, and all the people for giving me this opportunity to host this event. Today, as we know, we are focusing on the baby steps of technical analysis. Me and Grishma has taken out a very simple topic where you can start understanding about the market, the various types of pattern, the candlestick anatomy, how to read the candlestick, or at least what is bullish market and what is bearish market. So putting aside the things, let me introduce Mrs. Grishma Shah. She is from Mumbai. If I give a short intro, she is a choreographer, professional choreographer, past 14 years, and she's trading since almost 4 years. She has done her schooling and college from Mumbai only, and DMLT from Symbiosis Institute of Health Sciences, Pune. And today, what she would be speaking about is the trends and the patterns related to the markets. For me, I would be presenting about the candlestick patterns, what are the different types of candlestick patterns, and how to read the anatomy in the candles and the psychology behind it. We have our panelist, that is Professor Vivek Bhatia sir. So Vivek Bhatia sir was serving initially in his young days in entrepreneurship he was, and he was a manager in various MNC as well as other companies. Now, presently, he has retired at the age of 43. He's a young person at the heart and who is being a trader since 2007. He has a passion for teaching, and he is a visiting faculty for the MMK College and the KC College and University of Mumbai, where he is teaching marketing and management subjects to the graduates and postgraduates there. And he is a self-learned trader and also teaches to many traders across the globe. So we welcome both of you on this show hosted by our Moscone family. Welcome, Mrs. Grishma Shah and Professor Vivek Bhatia, sir. Meanwhile, I would now, can you, Grishma and sir, can you just, video? Yeah. Good evening, everyone.
Hi, good evening.
Good evening, ma'am.
Yeah.
Good evening.
So I hand over the mic to you, Grishma. Please go ahead.
Ma'am. Yeah. Thank you so much. So, yes, so I just assume that many people over here don't know, and I'm just starting from the basics so that nothing is missed out, at least from my side. So, yes, first of all, good evening to everyone, and I welcome you all. So, you see, we have like we are meeting here with a purpose to understand the market. So see, first of all, we need to understand that in markets, half knowledge is very, very dangerous, right? You know few things and you miss out on something, then there is no use at all. So first of all, we need to clear our basic concepts, right? See, we obviously, many of us enter in the markets with an intention of making money, but very few of us succeed because we miss out on many things, because there are certain myths, there are certain things that we tend to ignore, and that's the reason that we don't make money in the markets, right? So here basically first we will try to understand what all mistakes we do and what all things we should ideally focus on rather than ignoring. Okay, so first of all, why people don't make money in the stock market, or why do they lose? Main reason is they do not manage the risk. See, whenever you enter the stock market, first of all, the thing you need to identify is your risk appetite. Because in markets, see, market is uncertain, right? It is a very volatile thing. It's not like real estate. It's not like gold, where there is a certainty. There is a lot of uncertainty. And first of all, you need to identify your risk. It's not a risk-free instrument like FD. Okay. So first of all, you need to identify your risk. You should understand how much money or how much percentage of your capital basically you are willing to lose. Okay. So you need to identify before entering in the stock market what kind of a person you are. Are you a low risk taker or a moderate risk taker or a high risk taker? Okay. So that depends on your risk appetite. So first and foremost thing, very, very important that you need to identify is your risk appetite. Okay. So you should understand that suppose if you are investing 10 lakhs, so out of 10 lakhs, say if you are like able to take 10% of the risk, okay, then ideally that is your like risk reward ratio. So you are so out of 10 lakhs basically you are willing to lose only 10%. So that is your risk. Okay, so your reward should always be higher than your risk. So that is the risk reward ratio. So many people prefer 2% loss of their capital, or 5% or 20%. Okay, so that depends. So first and foremost thing is the risk reward ratio. Then now we will come to the stock selection. See, I will summarize everything in the end, but we will start first with the illiquid stocks. So see, what are illiquid stocks? Where there are no buyers and sellers, like not enough buyers and sellers. Okay, So like if you want to sell something but there is no buyer, okay, so such type of stocks are called illiquid stocks. Now, as you can see this chart, I have made this chart in investing.com. So basically, I have just copied and pasted this chart. So here you can see there is no volume. So there are no buyers and sellers. There are not many buyers and sellers. So therefore, it's very risky to invest in such kind of stocks or trade in such kind of stocks. So this is one such example of illiquid stock. Okay, now see, this is net link solution. See, even here, see, this is the volume bar and this is the price action. So just focus here on this bars. Okay. So see, there is no volume. There is no enough volume. Only single volume bar is not enough. There has to be equal number of volume bars. Okay. So see, these are illiquid stocks. See, even here, there is no volume. The stock is going up. So if you invest in such stocks, it will be very difficult for you to come out. Okay. Now see, so basically you need to understand that illiquid stocks are those stocks where the spread is less. See, how will you differentiate between liquid and illiquid stocks? See, in liquid stocks, suppose if the stock price is going 100, so you know the spread between the buyer and the seller will be like 100.10, 100.20, 100.30. So that is called the spread. Okay. So you will get to know the spread between the buyers and the sellers. If the spread, if the size is very huge, then that's an illiquid stock. Like if the buyer is willing to buy at 70 rupees, but the seller is willing to sell at 100 rupees. So the difference is 30 rupees. Okay. So this is an example of an illiquid stock. So the spread is basically very huge. So such stocks are illiquid stocks. So you should always avoid investing or trading in illiquid stocks. Okay. So then next is market capitalization. Now see, what is market capitalization? The current market price, okay, whatever is the price of the share into number of the outstanding shares, like the shares which are with the public multiplied by the current price of the share. So that is the market capitalization. Okay. So see, market capitalization is very important because that shows that so many investors or so many people are holding that particular stock. So higher the market capitalization, lower is the risk. Okay. And lower the market capitalization, that means that very few people are holding that share. So again, that comes under the illiquid category. And such stocks which are illiquid or such stocks which have low market capitalization, so very less information is available on such type of stocks. So one should always avoid such stocks. Okay. See, the one what I was saying, thin liquidity and thick liquidity, that is liquid and illiquid stock. So see, here you will see the volume is very low, and see here the volume is very high, right? And as I said, wide spread and tight spread. So what is tight spread? The what that I told you, that like 100.10 paisa or 20 paisa. Okay. Then see slower fills. See here you can see there is the volume bars are not that high, and here you can see the volume is very high, and volatility will be very high because see very less buyers and sellers are there. Okay. So someone who buys immediately, the price goes up, and here it takes time. Okay. So as a beginner, you should understand that you should participate in such stocks which are highly liquid and whose market capitalization is very high. Now see, there is a general categorization of the market capitalization. See, large cap are those companies whose market capitalization is approximately about 10,000 crore. Okay, like you see Tata Motors or TCS or Infosys or Britannia. Such stocks are large cap. Everyone knows about Maruti, Britannia, Tata. So you can just Google the company name, or you can just find on any app like investing or stock edge or money control. So you can just find the market capitalization. Okay, mid cap. So see, 2000 to 10 crore, like between 2000 to 10,000 crore, that category comes under the mid cap uh, company. Like that is the category. Then we have small cap. So small cap, the market capitalization is below 2000 crore. So these companies are very risky because their financial statements are not available. Okay, like not easily available. So it is very difficult, and the risk is here in the small cap. High risk is involved in the small cap. So one should avoid the small cap companies if you are a beginner and if you are not someone with high risk. Okay. Now see, here it is already mentioned large cap, mid cap, and small cap. So see, here in large cap, the risk will be low. Okay. The risk will be low, but then the returns will also be comparatively low because the risk is not involved. Okay. So see, probability of exceptionally high returns, obviously it's low. Liquidity, very good. If you want to sell anything in large cap companies, it will be very, very easy to liquidate. Okay. Company information availability, very good. You will get all the information. Then related to mid cap, yes, the risk is high, not very high, it's high. Then probability of returns, it's high. Liquidity, it's good. Okay, and company information is also very good. And in small cap, the risk is very high, but the return expectations are also very high, and the liquidity is low. And if you want to get any information related to the company, so that will be very poor. Okay, so as I mentioned earlier, you need to identify your risk appetite, and accordingly, you have to decide what kind of a person you are and what kind of stock you can invest in. Okay, then now see, this is an example of the market capitalization. See, this is I just Googled and I had pasted this screenshot. So see, this is the Britannia share price. So here you can see the market cap. It is 93,000 crore. Okay, 93,000. See, you know, a large cap market capitalization should be about 10,000. So here it is 93,000. So obviously this is a blue chip company. Okay. Now see, this is Ambala Sarabhai. Here, if you see the market cap is 232. So it is highly risky. And here you can see that there is like huge volatility, right? So you should avoid such kind of stocks because even if you enter, you won't be able to exit on time. So first and foremost thing that you need to identify the stock which you are willing to invest in, whether it is a liquid stock and whether the market capitalization is medium or it's high, like it's either mid capitalization company or large. Okay, then you should avoid penny stocks. Now, see, penny stocks definition is not that below 5 rupees. There is no such definition. Penny stocks is where retail participation is high. Okay. So, see, why? Because retailers can afford stocks that are very cheap. They feel that they can buy it in bulk. And many people feel that, अच्छा चलो 5 रुपए का लिया ज्यादा से ज्यादा zero हो जाएगा. Okay. So this is the psychology which plays. And just remember one thing, that retailers don't have the capacity to move the price of any stock. Okay. Now see, what are the advantages of the penny stock? Okay. See, the share price is very low. It's like 5 rupees, 10 rupees, 15 rupees. Okay. So it is like favorable for bulk purchase because you can buy in quantities. You can buy like 1,000, 10,000, right? And there is high potential for reward. See, if the stock turns around, then it can go from 5 rupees to even 25, 30, 100, it can go, right? But what are the disadvantages? It is very, very difficult to get the information about these companies. Then you will find it difficult to make the decisions. Then there is lack of liquidity. See, lack of liquidity is like because the big players are not involved, retail participants are involved, and they are like prone to pump and dump. See, because the price is very affordable, anyone can buy it. So there are chances of manipulation. Okay. And the stock can even go to zero because it can delist. See, if the stock price is very cheap, then high chances are that there is no value. And that's why the stock price of the stock is low. So you should, as a beginner, you should avoid the penny stocks. Okay. And there are chances of losing money. See, even if you buy 10,000 quantities, say 5 rupees is the stock price, and you are buying 10,000, like you have invested 50,000, chances are that your 50,000 can become zero as well. Okay. Now, another concept is smart money. See, in market, we need to understand that money is the fuel, your capital is the fuel. But as a retail participant, we have very limited money, right? So only big players like smart money, we see. So only they have enough money, they can manipulate markets, they can move the markets. Okay. So we don't have that kind of money. Even if we invest 100 crore, so that money is not enough. See, mutual fund houses, banks, and say fund houses, they have lots of money because they collect from people. They have that pool of money, so they have so much capital, so huge capital, that they can move the market. Okay, so as a retailer, we don't have money. So as a retailer, we should follow the smart money. Okay, now what is smart money? Smart money is one who has information, who has some vision. See, there are many big players in the market. So it's very important to follow the smart money, right? See, these people have that capacity to move the market. Okay, because they have that kind of money, they have that kind of information, and for that reason, they have uh, like bought those stocks. So it's not that you should copy their portfolio, but you should at least know that whatever stock you are willing to invest in, if any big player or if any fund house is involved, because if the mutual funds or maybe any institutions are not holding that stock, then that stock won't move. Okay, so you should first check the holdings. So now here you can see institutional investor, like as I said, mutual funds, insurance companies, banks. So they invest and manage other people's money, right? And retail investor, like we invest our own money, and they trade more frequently, we trade less frequently, right? Then they deal with large amount of money that has the ability to affect the stock market. That's what I said. And invest relatively small. See, so retailers, basically we have limited money, as I said. So we invest small amount of money, but they have that kind of money that they can move the market, right? And obviously our brokerage fees are very high and theirs is low, and they have that kind of knowledge, they can research, and they have all the resources that are available, right? They can mutual fund houses or institutions, they can just go and they can meet the CEO and they can get all the information. We cannot have that kind of privilege, we don't have that access, right? So we have very few skills and we have limited knowledge, right? And they can get any kind of information, but we get very limited information. We get the information which is only in the news, right? So that is limited. But people who are investing our money, so they usually have all kind of information. Okay, now see, these are institutional investors, as I said, mutual funds, private equity funds, pension funds, insurance companies, right? Hedge funds, venture capital. So they have our money, so they can invest and they can move the market. So we basically have to follow them in stock markets. We have to invest in stocks where this kind of institutions are involved. Okay, now coming to trends. Now see, trend is a very simple thing. See, as you see, you don't have to complicate things. See, trend, like if you just open anything, if you open a chart, if you see something going up, it's uptrend. Now see, here it's going up and down, but overall the trend is up. Okay, now see, what is the exact definition of uptrend? See, first of all, we would it is necessary to understand what is support and resistance. Okay, see, any stock won't directly go up, it won't go in the same direction, like, okay, there will be some corrections as well. Okay, now see, so from here, see, if you just look at this point, from here the stock was not able to move up, so this is called the resistance point. Okay, so whenever the stock gets rejected from a particular point on the upper side, then it is called as a resistance point. So see, this is the resistance. Okay, so here the stock faced the resistance, then it corrected. Now, what is meant by correction? See, the stock did not entirely go down. Okay, it just corrected halfway somewhere, and from here the stock again went up. So this is called the support point, because from this point the stock went up. So this is called the support point, and then the stock again started moving up. And the stock, when it stops here, then that is called the resistance point. Okay. So see, in uptrend, the support, whenever you draw a line or joining all the supports, then sorry, the stock keeps going up. So basically, in uptrend, you will usually find that all the support points are joining each other. See, here in this example, if you see, this is the support point, this is the support point, here is the support point. So see, basically, after joining all the support lines, we get to know that this is a clear uptrend, and this line is called as the uptrend line. So this trend is basically uptrend. So we need to invest in such stocks where there is an uptrend. Okay. Now see, this is a downtrend. As I said, that see here, that is the resistance point from where the price is getting rejected. That is called the resistance point. Okay. So after getting rejected, when the price, okay, I'm sorry. So after getting rejected from a particular point, when the price goes up, so the bounce is less. Now see, from here, see, this is a clear downtrend. The price fell down, okay, here, and then again it went up, but it was not able to cross this previous high. Okay, so this is a clear sign of an uptrend. Now again coming down, this rise, this bounce, this was not above the previous high. Okay, so this is a clear indication that the stock is in a strong downtrend. So in a downtrend, you will be able to join all the resistance points. See, this was a resistance point, this was a resistance. So roughly you will be able to join. Okay. So this is the high, then again this is the low, then again this is the lower high, right? See why? Because the high is not above this high, it is lower, right? It is lower than the previous high. That's why we say it's lower high. Then again lower low, right? Because this low it's here and this low is here. So this low is lower than the previous low, right? So this is how that's a downtrend. Okay. And see, this is a sideways trend. The stock does not go anywhere. It's like in one tight range. Okay. The stock comes down, then goes up. So see, this is a range. The stock is not going anywhere. Okay. So it just keeps on bouncing off within a range. So it is very difficult to make money in such stocks. Okay. So it's advisable as a beginner to stay away from this stock. So see, this is a summarized thing. So see, this is a higher high, then higher low, because this low is higher than the previous low. Again, it's higher high. Why? Because this high was the previous high, right? And this high is higher than the previous high. Then again, higher low, higher high. So this green one is an uptrend. Okay, so uptrend is what? Higher high and higher low. Series of higher highs and higher lows. Simple. Sideways we can almost same level, lows and highs. So they are basically confined in one range. And in downtrend, see, now from here the stock came down. So this is a low. Then after that, this high was there, but this was not higher than the previous low. That's why we say lower high. Okay. Then again, one low was made, but this was lower than the previous low. So we say lower lows. And again, lower high, because this high is not higher than this high. Okay. So see, it's very simple. To summarize, what is an uptrend? It's like series of higher highs and higher lows. Sideways is within one range, and downtrend is lower highs and lower lows. Simple. And now see, after that, you need to focus on sectors. See, there are few sectors that outperform. Okay. So sometimes like banking sector outperforms, sometimes IT sector outperforms. So you need to identify which sector is outperforming. Okay. So suppose if automobile sector is outperforming, then you need to focus on automobile stocks if you want to make some quick money. Okay. So you can invest in liquid stocks of automobile sector, or financial services if that sector is outperforming, or media. So see, these are the sectors in NSE, right? say financial service, automobile, consumer goods, industrial manufacturing, metals, power, etc. So you need to identify which sectors outperforming. So this is also one of the criteria for selecting your stock. Okay. See, Nifty IT index is there, realty, auto, pharma. Okay. So now, what are the criteria for the stock selection? So first and foremost important thing, avoid illiquid stocks. Okay. We have already discussed what are illiquid stocks. Okay. So avoid illiquid stocks. Then invest only in medium or large market capitalization stocks. Okay. Then avoid penny stocks. Don't go with them. No money will be made. You will only lose the money in penny stocks. Then invest only where institutions or smart money is involved. Okay. You need to check this before investing or trading in any stock. Then avoid downtrend and sideways trending stock. As I said, you even if your stock selection is right, even if the stock is liquid, even if the market capitalization is large, even if there is no penny stock, even if the institutions are involved, if you invest in sideways, you will never be able to make money. So always check the trend of the stocks. Very, very important. Okay, and sector performance. So if you are willing to invest in a particular sector, so just focus on that sector. Okay, or you can go with a theme based. Okay, suppose if infra or say road construction. So, you know, everything related to road construction, like what all things are required, cement. Okay. Then electricity is also required. Capital goods is also required. So that comes under a particular theme. Okay. So if housing thing is like going on in India, so you know that paints will be required. So that's a particular theme where many things are involved. Cement sector will be involved, paint sector will be involved. So that comes under a theme based. Okay. So after checking, okay, and after making a checklist that yes, I have almost covered all these points, then you can select your stock. But identifying the trend is very, very important. Avoid downtrend and sideways trending stocks. So I thank you all. And if any questions are there, you can
Fantastic.
ask. Thank you, sir.
Very nicely put up, Grishma. What I
Thank
would
you.
like to now, question and answers we'll take during the panel discussion.
Sure.
Very interesting. I think the memo is public. The members are definitely well educated on trends, the uptrend and the low trend and the sideways trends, and it's going to be a big help. So over to you, Trupti. Now we have the next session which is coming up regarding our own in-house consultant, Dr. Trupti Kadam. She has done her MBBS in this from the Sion Hospital, MS, and then she has done her post graduation. Following that, she did a fellowship from 2009 to 2012 in pediatric neuro and squint at the LVPI Hyderabad, and she is a keen follower on the invested market, and she's learned the technicals very nicely, and she's today going to give us an idea on candle anatomy. So over to you, Trupti.
Thank you, sir.
You can share your presentation.
Yes, sir.
Yeah.
Good evening, all. I'll be Grishma, good talk. As we had discussed, like we just wanted to keep this platform very basic related to technicals, so that the newbies, whoever are there, it would be fruitful for them. Today, even the candlestick anatomy, which I am going to present, am I given the to share the screen? Please give. Okay, it's already given. Thank you. So good evening. I'll be speaking chiefly on the candlestick anatomy. Very basic things of candlestick I will try to cover. I will not be, focusing on all the candlestick patterns, but which are the common patterns and which we usually see and which can help for our trading. For that purpose, I would be doing it. Before this, I don't have any financial interest, or neither I do have paid services. Today, it is just an educative purpose. I'm not responsible for your profit or loss. Neither I'm a CD registered. I'm a very novice trader who just, past 2 years, I'm just trying to see. In last year I have, and I'm very thankful to all the teachers who have taught me till date. There are innumerable of them, and I learn from everybody, whether it's Grishma or whether it's anybody. I have learned from all of them. So if we go to the candlestick, that why this candlestick, what is the history behind it? Basically, this is related to a Japanese candlestick, and the methodology dates back to almost 1600, and where the rice farmers used to monitor and forecast the corn prices. There was a famous trader, Huma, during that period of time, who realized that these markets were strongly influenced by emotions. And his theory was then propagated by Steve Nissen, and there the candlestick, Japanese candlestick publication was being done. The second edition is there. Now, why do traders prefer candlestick pattern? So, as we know that each candlestick, that OHLC is open, high, low, close, and which are the price movement it gives us. It helps us to depict the market and the trading psychology. It through the candlestick, we would be able to identify the trend, whether it's a bullish trend or it's a bearish trend. Bullish is higher high and higher low. As Grishma has explained, bearish is lower high and lower low. We should identify the continuation of trends and the patterns, and this gives a predictive value. It gives a two-dimensional figures, which is easy to understand, and with the ability, it does highlight the price movement, the trend weakness, and reversals, which we can be seen on the bar chart also. Can't be seen exactly on the bar chart, but through the anatomy would be. Now, what should a trader interpret from a candle? What does the formation of the candle say? What is the psychology behind the candle, and how we should do the trend confirmation? Shortly, now this is a candle, two-dimensional figure of a candle. We have a red candle and we have a green candle. Green is bullish, red is bearish. Now what happens? Why red is called as bearish? Now, if we go back to the formation of candle consists of open, high, low, and close. Now, what has happened? Why the red candle has come? Like suppose if yesterday's closing was 40 and at next day it opened at 30. So it has opened below the closing price. So that's why we get a red candle. We do have, this is called as the real body, which is there. We have the wicks, that is the upper shadow. This is upper shadow, and this is the lower shadow. Now this week, what it will, the psychology behind it is, it will let us know who is having the pressure, whether the buyer is having the pressure or whether the seller is having the pressure. Similarly, when we'll get a green candle, we will get a green candle, like if the price is closed yesterday at 40 and next day morning it is opening at 50. So it is, since the yesterday's close, it is closing high. So this is called as the close price in the green candle, while in the red candle, it is on the downside. And it does have a shadow. Now, looking at the candle, what things we should know? What is the pattern? So what is the pattern? Like, is it a uptrend or it is a downtrend? Where is the pattern? Now, is it at the support or is it at the resistance? Means it is at the bottom or it is at the top. How big is the pattern? Now, in which time frame you're seeing this candle, it depends on that. And how much is the volume participation? Like, is there a built up in the volumes? Then the trend would be changing with respect to that. Now, what pattern candles, what we can see is a single candle, we have double candle, and we have triple candle. Now, a single candle can be a bullish candle as well as a bearish candle. So in single candle, what we have a doji, a marabazu, a hammer, an inverted hammer. In bearish, what we have is a gravestone doji, the hanging man, and the shooting stars. The doji are the important things where they do direct the direction of the market and they are more strong. In the double, if it is a double candle, then what we have to know is the harami pattern, the engulfing pattern, the tweezer top, the piercing, and the dark cloud cover we should be knowing. In the triple pattern, what we have is the bullish and the bearish, where it is the morning star and the three soldiers, while in the bearish, it is evening star and the three black group. This is just, different types of candle, what are there. I'm just trying to say that on the right-hand side is all the bullish pattern. On the right-hand side, it is all the bearish pattern, and on the left-hand side, it is all the bullish pattern. With the two candle patterns, the single pattern, and the three candle patterns, which are there. Now coming back, I'll explain the commonest thing which are related to this single candle patterns and in different types. First, extremely important is your doji. Now, any candle which is being present in the market, it can be at the bottom or it can be at the top. The bottom is called as the support. The top is called as the resistance. So if the candle is at the bottom, at the support, that is, it is at the demand zone. So it has a probability of giving you a entry at the buy, where a trader can buy and ride. So this doji candlestick pattern, it can lead to very high profits if you know where it is present, and its versatility can be experienced in the various time frame. Basically, if you see, this is a common doji, what we see, where the wicks are there. The wicks indicates the seller pressure as well as the buyer pressure. Here, the seller and the buyer pressure is equal in the common doji, and these are the most powerful point of doji, where you can say they will head you towards the northward if it is at support, and if it is at top, it will head you to the south pole, that is on the downside. Okay, so in this we have different types of names to it. We have a long leg doji. In the long leg doji, it depends. Like if your lower wick is long, so it indicates the the buyer pressure, those. And similarly, this is a dragonstone doji, where it indicates that the buyer pressure is very high, and this is your close, which is there. Dragonfly doji, always remember, if it is at support, just remember a dragonfly, the way it flies, it flies high, so the price is going to fly high. That you should be remembering up. We have the gravestone doji, where the gravestone meaning itself is depicting that we can see a downtrend if it is present at the resistance. And the different another type of dojis we have is a spinning top doji, as well as which can be bullish or bearish, whether it is present at the support or whether it is present at the resistance. That is very important. So whenever doji is there, the open and the close is same. So what does it indicates is an indecisiveness. It indicates that the buyers and sellers are getting momentum, but the confirmation would be only there after the appearance of the second and the third candle, and the direction would be confirmed. So this is like, I'm just trying to show you, this is a Nifty IT chart, and this is 1 hourly chart where if you see, like this is a gravestone doji which has gone at the resistance, and from there we can see that how this made a move downward journey. So that's what I said, the South Pole journey, what it made. And here the small common doji came and it gave again an up move, and you can see that the price has reached to 28.49 and it gave an upward journey. And this is another long leg doji which is there, but later after this it failed and then it has come down. This is a dragonfly doji, what I said, that dragonfly helps you to fly. So the price from this bottom which was being present, as well as this small spinning top kind of thing is there, from here it almost traveled and made their journey to 28,549. So these are the different pattern for it, which will be helping you to know. This dojis has a very good, if you know it and you can interpret it properly, it will help you to make good profits in your day-to-day activity. The other single stone is that Marabazu, which I would be coming, where you can see this is a single where it indicates a strong buyer pressure. And this is a strong negative pressure on the bearish side where the price is coming down. So in Marabazu, what happens, like here, the open is equal to low. We would have seen many times, traders keep on finding open is equal to low, which stocks are is equal to in the opening, open is equal to low. So they have a tendency to move up, and here the buying pressure is there. This is a strong buying candle which is there. You can close your eyes and you can trade on this if Marabazu candles are there. That day you would be having a good profit day, what I wanted to just. And similarly, if your open is equal to high, they always say Nifty ka aaj open is equal to high, so take the P, sell. So this is the thing which happens in Marabazu. Now another is the hammer pattern. Now if it is a bullish, if it is at the support, this hammer, if it is at support, now this is your real body and this is your tail. The tail which should be of the hammer, it should be more than 2x of the body, which has to be there. And this would be confirmed by a next candle. So that would be able to help you to know the direction of the market. Suppose if this is present at the support, then what that it usually occurs at the end of the downtrend. So you can see that these are the 3 crows. After the 3 crows, what we got it is this hammer, and through this hammer, the next confirmatory candle has come. So there is an uptrend. Similarly, if this candle, it is at the resistance, means if it is at the top, so what does it will indicate? It indicates that there is an end of the rally, which is there. And this would be confirmed by the next candle, where it would be breaking this low of this candle, the low would be broken here, and then it would be giving a confirmation that I'm ready to go down. Another is your inverted hammer. This inverted hammer can be present at the support, or it can be present at the resistance. So when it is present at the support, it is inverted hammer. But when it is present at the top, that is at the end of the uptrend, when it is present, it is called a shooting star. So this should be correct. Here, what does it indicates now in inverted hammer? You need to know that this upper shadow which is there, it is formed, and when the bull tries to push the price up, whereas the lower shadow is formed by the bears who tries to resist it. Usually they occur at the reversal of the either downtrend or the uptrend. And what it shows that the bulls are back into the market, either if it is in the green side, and they have started putting buying pressure to make the prices high, and bears are unable to bring the price down. So this is, if it is a shooting star, it will appear at the end of the rally, and the wick could be wrong. There would be a small tail which can be present, may or may not be present. So I'm just explaining like the power of all these things, whether it's a doji, whether it's a single candle, or whether it's a marabazu. So you can see this is a marabazu candle where the low was being broken. This is Tata Motors on the daily time frame. And from price from 460 almost came to 376. And here we got a long leg doji at the support, and from the support we could ride till this, when this uptrend reversal what it gave, like I have done my rally. So the doji has appeared, and from here again you can see that the southward journey, south pull journey started. So it gave a positive hammer. With the positive hammer, you could see the price moving up again. But later, like this is an inverted hammer, what I discussed, like a shooting star which comes when it comes, and when the shooting star low is being broken by second candle, and again this low is being broken by the third candle. So you come to know that you can straight away give a plus 5% stop loss, and you can try to reach till the support. You can mark this 376 should be your target, but this price almost came to the price of 366, where it formed a small hammer. This hammer was at support. Since it was at the support, what it did, the next candle, it broke the high of this hammer, and then we could see a journey which was up an upward journey, and which the upward journey ended with a doji. This is a doji where the price could reach till 449, and this 449, as we know, 447, 447, 449. So this is a resistance. So usually these resistances are never crossed within first or second attempt. They usually take 4 to 5 attempts to cross this resistance. So definitely what you would always try. So this is your supply and this is your demand. So again, the price came down. So instead of 366, the price came to 376. So what the hammer, it made a doji. We know that the doji at the support, we know that there would be a possibility of buying pressure. And this was followed by a confirmatory and hammer. Again, this hammer high, both the high was being broken by the second candle. And then we could see the upward journey, which is being there. So, and what it made was a double bottom it made, almost like a triple bottom it made. And then it moved up. So Tata Motors currently it is at 554. Just an example, what I have tried to explain. Now the double stick patterns. In double stick pattern, what we have is an engulfing pattern. Now, if you look at this candle, like this is a small red candle. And besides that, this is a bigger green candle. There would be a wicks present in this. The wicks would be small. They won't be, it may or may not be present, those wicks. But this candle has totally engulfed this candle inside. And this is a big thing. So this patterns are the reversal pattern we should be knowing. As we said, if it is at support, it is bullish engulfing. If it is at resistance, what we get, this is a big red candle and a small, and it is being totally engulfed, completely engulfed by this. So what will this indicate is the end of the uptrend and the possibility of downtrend. So this is a reversal to the downtrend. This I'm being explaining completely on Nifty, where this is a weekly chart where you can see that this candle was totally engulfed. This is a bullish engulfing candle. Here also you can see that this candle was being engulfed and how the upward journey started. Similarly, here means the March 2022 high, what it made was 18,114, and after that it came down. So here you could see the bearish engulfing pattern at the resistance. Whenever it comes at the resistance, we should know that there is a sell point and the candle will come down. And this was confirmed by the hammer. And this hammer slowly, the high was being broken by the second candle. And then we could see an upward journey. And again, this doji came. As I said, whenever the doji came, they are strong. Here, the doji, what it shows, the wick, this wick is, upper wick is strong. So it indicates that the seller pressure is more and the lower is, buyer is slightly weak. So we could see it's coming down. So it did come down. But here what it made a tweezer bottom, what it made here is a tweezer bottom. And with the tweezer bottom, it has gone up, where with the candles also you would be able to know, just you need to concentrate whether it is breaking the low or the high, that you should be concentrating up very well. Now, in this successive candles, what you can see is that that the high of the low of these candles were never broken, never ever broken from past 5 weeks. So next week, now what is the next step we could see? And this is a Marabazu candle, what we had this last week. And with this Marabazu candle, are we going to have more upward journey, or whether it will give some reversal candle and we'll try to reverse down? Let's see that. So another pattern which is called as harami pattern. In Japanese, the harami means pregnant, So just like a mother is carrying a child in her womb, similarly in harami patterns, like what you could see, this candle is inside the body. The second candle is inside the real body. So that is very important point you should be seeing. For a bullish harami, the initial means it will occur at the end of the downtrend. So this would be a red candle followed by a green candle, where it would be at the support. If the low of this candle is being broken, if the high of this candle is being broken and low respected, we can get a next day, a green candle with a gap up. That's what I wanted to tell. Is bullish harami candle is formed when a large bearish red candle appears on day one. This is followed by a smaller bearish candle on the next day and a gap up where it breaks the high of this previous candle. Bearish harami is formed where there is a large bullish candle. The next day, we get a small red candle within the body of this, and this is followed by a gap down where it is breaking the low of the previous candle. So presently, what I just saw, like this, you can see this is an ICA on the daily time frame, and NICA you can see like this is a end of the downtrend, and this candle which is being appearing where the candle is inside the body of this candle. So this is a bullish harami, and we could see that the next day it was a gap up, and later again it came down with a bearish engulfing. But again, the stock is not giving up. There is a tussle between the bulls and the bear at the level of 1400, and the this at the end, what you are getting is a Marabazu candle, and the buyers want to take the stock up. Now let's see whether so many days this was in a sideways, what Grishma has said, whether it will try to break above 1400 level. So this is another stock where the KPR milk, I am just trying to show you, like bearish harami has pattern appeared. Now whether tomorrow it opens gap down, and with this gap down, whether it comes more down, let's see. Just trying to explain how to read about, like you can see here the doji came, and from the doji, the low was not broken. Again, the third candle low was not broken. The high was broken, and then you could see the upward journey. So based on the candlestick also, there is a, but candle should not be used in completely in isolation for the trading. You have to use it with volumes, like because of the volumes, there is a spikes over here. I just wanted to highlight this, or you can use the indicators also. So another pattern, what we call is the piercing pattern and the dark cloud pattern. This pattern is a bit difficult for few of the novice trader or to understand. But what I just wanted to tell is that if the bullish pattern is called as the piercing pattern, and the bearish pattern is called as the dark cloud cover. Always this pattern should be seen either at the support or the resistance. They should never be seen in between. Okay. Now what you will get in the piercing pattern, like you will get a red candle. Okay. The next day, what you will get is a green candle. But like this piercing pattern, which is found usually at the end of the downtrend. It is used either as it is used to enter a long position, or if you have done a short, to exit that short position of selling. So this pattern, when it is formed, when the both bulls and bears are fighting and they are trying to gain control over the prices, at that time what we get is the piercing. Now here the first candle should be red, having a large real body, and the second candle should be green. But this, sorry, I'll just go behind. But this green candle should be breaking the low of the previous candle. This low need to be broken. Okay. Similarly, now dark cloud pattern. Dark cloud pattern is a bearish reversal pattern. It is used to either for the sell position or to exit your buy position if you're done. So in this dark cloud pattern, what is more important is that in this dark cloud pattern, here the low of the green candle is not broken, and the close of this day 2 candle should be more than 50% of the day of the first candle. So this what we can see. So this are the piercing and the dark cloud pattern. The another pattern which we commonly see, basically this would be more commonly seen on a 1 hour time frame or a 15-minute time frame if you're doing Nifty or options or any other things. Like in that, what we see is a morning star pattern. So sun rises, so the stock price also rises. Evening star pattern, sun sets down, so the price is also going to set down. It is that kind of pattern. So in morning star pattern, what we get initially, like we will get a red candle at the end of the downtrend. This is given by a gap down candle where it is a doji candle. And later, that is, this can be bearish or bullish also, whatever it can be a red candle or it can be that doji can be a green candle or a red candle. But later, this high is being broken, and you can see this three candles this way, and but this should be with the confirmatory next candle. What is the next candle appearing? But if it is at the support, it gives a very good trade to you. Similarly, the evening star, like sun is going to set, so the price is also going to set. So this is usually seen at the resistance, where the first candle, the first candle body is long. The second candle, which is there, is usually a doji type of candle, and this is followed by the red candle, where the third candle body closes into the body of first candle. This is very important, closing into the body of the first candle. So this is your bearish candlestick pattern. So whenever you get this, this can be followed by your, if it is a bullish pattern, then it would be followed by three white soldiers, what we see, that big Marabazu candle, where if it is formed and at the here it form a engulfing pattern, where it engulfed this completely, and then we can see the three white soldiers marching up. And remember, the low is not being broken at all. It respects the low of the previous candles and breaks the high of every candle. So this is your three soldiers pattern. The next, like in bearish, if I told you that if you get an evening star, the price is going to set. So the low are going to get broke. All the low are going to get broke. And you will get this three crow pattern. The another is like an abundant baby, where the doji would be extreme at down end at the support, and from there you can see the marching of our soldiers and taking the price up. Similarly, we can have a bearish abundant baby and then breaking the low. So this is, I just tried to explain this on the 15-minute time frame of Nifty, where this gave a piercing bottom, which was there, like it broke the low of the first candle, and then the confirmatory candle came, and then what we had, a dark cloud cover, where it is in 50% of the body, the dark cloud cover has closed, and is being followed by an hammer, and then again the price going up, nothing. And here is also your three soldiers which are marching up. Here is your evening star, where this is a big body, this is followed by a doji, and this third candle is within the 50% of the body of the first candle. So this is an evening star, and this is being followed. Whenever evening star pattern is there, you can close your eyes and do short and mark the support. So this was the support, and from there we could see how the journey, it ended here. Always the pattern is you would be able to see at the end of the journey, like this was a south pole journey, ended with a morning star pattern, and you can see on 15th of the month. So how, with the morning star pattern where the doji is being formed, this is the end of the downtrend, and it gave a doji, the high is being broken, and then how it has traveled with the morning star. this is about the pattern of them. Similarly, just wanted to highlight how if whenever this is a strong pattern, three soldiers and this, so never, whenever you see this three crows, that is black crows, so it is a shorting opportunity. So to conclude, whatever trading timescales you are, candlestick stool is a powerful tool, and it helps us to judge the market and the direction of the market on the screen. It should not be used in isolation, which I explained. So use indicators, or you use volume, or you use moving average. And it helps by using this, it helps us in a better successful trading and technical analysis. So to conclude, at the end, I would just like to say, you should never start trading without understanding. Before you start, you should learn. Before you enter, you should plan your trade. Before you gain risk, you should be able to manage. Before you quit, try. Before you win, execute. And before you enjoy, endure. Every trade call has a story, so never take random trade. Look at proper resistance, support, and the psychology behind the candle. It itself telling you what I am going to do, what I am not going to do. That candle is going to trade. So always trade with a positive move. Don't oversize your position. Stick to your trading plans. Have patience. Wait for the support. Exit at the resistance. Use judicious stop loss. Don't trade for the sake of trading. At the end, your trade should end in one of the four ways: either a large win, either a small win, either a break even, or a small loss. But never write your losses. Thank you.
Very, very nicely covered, Trupti. The insights that you have given regarding the candle anatomy, the way we have anatomy as a medical term, you have dissected it so nicely and given a proper idea to all our beginners, in fact, all the MOS members who are going to use this technical analysis, what Grishma and you have covered is going to be a big help. And now let's have the panel discussion on this subject, both the subjects. So you can start asking questions to the speakers and the panelists. Yeah, Trupti.
Tripti, good evening. Before you can continue further, can I just add one more line to your rules and regulations of trading?
Absolutely. Absolutely, sir.
Friends, just keep one thing in mind. The last slide which Tripti gave you is an ocean of information. To that, add one more single liner. Always plan your trade and then trade your plan. As doctors, you always plan your operations and then operate according to your plan. You will never enter an operation theater without planning your operation. Similarly, you always plan your trade before the market opens, and then you trade your plan to safeguard your capital. That's just one piece of advice, along with what Tripti has given you as an ocean of information and knowledge. Thank you, Tripti. Wonderful presentation.
I would like to have your comments on Grishma's talk also, Vivek sir.
Grishma, if I may say, has covered her topic exhaustively. So, I mean,
yes,
there's nothing that I could like to add to her. Tripti, I just wanted to add one thing because this is something which I just read recently and it was quite appropriate to the panels that we are talking about, the doctors that we're talking about. They would understand this. Secondly, since Tripti has opened the topic and named her topic as the anatomy of candlesticks, it's appropriate that as doctors, you understand that you have to understand what the candlestick is trying to talk to you about. When you are a trader, You have to understand and learn the language of what the market wants to talk to you. And market only talks to you through candlesticks. Everything in market that is price related is always within the candlestick. So learn the art of candlestick language. You have to learn to interpret a candle by watching a candle graphically, and then take your trades accordingly. So that would be my 2 cents to the esteemed
Thank you, sir.
On the show.
So rightly said.
I just wanted to say, like, I'm very novice, I'm not like a very technical expert, but for the for fraternity, I attempted and I tried to give my best.
It was
very well
good.
done, ma'am. Very well done, ma'am.
Now they must be having questions. And Trupti, would you like to open up the panel discussion?
Sure, sir. Just let me know. I don't know the audience questions if they are having.
Yeah, Jyoti, just check the YouTube and the Facebook. If there are any questions, post it in the chat box so we can ask the panelists. In the meantime, as she is searching, I would like to ask you the time frame that a trader or an investor should take in for our MOS members. If you can guide us, Vivek sir, regarding the trends, like the weekly trends you should take, hourly trends should be taken, daily trends, depending upon an investor and a trader. Can you guide us on that?
Sure. Dr. Taswal, sure on that. Now, keep one thing in mind. Whenever you start observing a trend in the market, you always observe the larger picture first. So always check your trend on a monthly time frame, on a weekly time frame, then come to your day time frame. Now, doctors being doctors are not traders. They are professionals who are into a different thing of serving humanity and taking care of the health. As a trader, if I am working on a 1-minute chart, I am not looking at anything else. A doctor cannot afford to look at a 1-minute chart. Because if you're looking at a 1-minute chart, that means he's practicing only after 4 o'clock. As a doctor, I expect him to be practicing 24 hours a day, of course, with his rest. So I would always suggest a doctor to take a swing trade or a position trade. So for all that, always watch a trend first on a monthly basis, then narrow it down a weekly, then come down to a day chart. If you were watching the charts which Trupti was and Grishma was showing, they were very clearly weekly charts and day charts. So you would get a trend over there, and then you always buy at a support zone. A support zone is somewhere where the prices are regularly bouncing back from. And markets are cyclical in nature. If they go up, they will definitely come down. They will never go up in a straight line. There will be a zigzag movement. They will definitely come down. So you wait for the retracement to come when the price comes down, where originally it has bounced from, and buy it over there, which both Grishma and Trupti were very clearly saying support and resistances. In all their charts, they clearly demarcated that. So to answer your question, yes, identify a trend with the biggest time frame first. If monthly, wonderful. Else take a weekly and a day chart and then take a trade.
Quite right.
And yes, always remain patient whenever trading. Patience is the key over here.
Rightly said, sir. Regarding a different trend pattern on a monthly, daily, and an hourly, which this thing should be taken there?
Then it all depends on what kind of a trader are you. Are you going to hold a position for about a week? Then I will take a chart of a 4 hours or 1 hour or a day. If I'm going to hold my position for a week, that means I'm expecting a smaller target. But if I'm expecting a large target, then I can take a day chart or a week chart and expect my target to achieve in about a year.
Right.
So in that case, my target run will be very high. So it all depends upon what my frame of mind is, as what kind of an investor am I? Am I looking at for it in the long run or the short run?
Quite right, sir.
So that's the way it should be done.
Questions from Trupti?
So no questions, sir.
Audience, I think, have learned quite a bit. They have absorbed
If there are
everything.
no
So
questions, means
questions.
they are not understood. I should take it that way. Very difficult topic it is, but
Very nicely covered. So now I think it's past almost an hour and a half that we have been talking about these two topics. Well covered by both of you, and very nice pearls of wisdom by Vivek sir. So as there are no questions, we come to an end to this interesting session on technical analysis. This was the basics, friends. So we'll be covering step by step into the next series. We go up the ladder and try and cover more about technicals. So be with us. And I'm extremely thankful to Grishma, our guest speaker, a good friend of mine, and Dr. Trupti Kadam, our in-house consultant, who has done more of anatomy and stocks than I think in medicine. So it's so nicely covered. And of course, Vivek sir for his short stint and pearls of wisdom on technical analysis. Thank you very much. The Jyoti would like to have a quick gallery view shot and then your video followed by the official vote of thanks by Dr. Rajesh Joshi. So thank you very much, each one of you. Can we have the videos on of all the panelists? We have a gallery view shot. Jyoti ma'am, are you taking one? Hello. Can you stop share this? Yeah. Are you taking a gallery view shot, Jyoti? Trupti, I think you can do it if you're on a laptop.
Yes, sir. Taken, sir.
Yeah, it's taken.
Yes, sir.
Thanks a lot. Now over to you, Rajesh. I think he's logged in, but he's quite busy. He was just telling me. So anyway, as he's busy, and official thanks on behalf of the Maharashtra Ophthalmological Society to my dear audience who have joined, our speakers, the guest speakers, and the panelists, and Dr. Trupti Kadam for being with us, taking time out on a Sunday night, and teaching us about the technical analysis. Thanks to the Ento technical team also for being with us throughout for a streamless, absolutely without any problem. We had the technical support. So a big thank you everybody for joining us. More about it in the future. Thanks a lot.
Thank you so much, sir. Thank you, Vivek sir. Thank you, Rajesh sir. Trupti ma'am, it was a lovely presentation.
thank you.
Enjoyed
Grishma, I
it.
can't match your presentation.
No, ma'am. No, it was very nice. And obviously, I got to learn a few things from Vivek sir also. Sir, thank you very much. Thank you, Jignesh
Welcome.
sir. Thank you for
Thank
giving
you.
me
Nice.
support.
But,
Thank you, Rajesh
I
sir.
don't know what happened.
Thank you very much.
Thank you, everyone.
Jyoti, can we have